Hello everyone, welcome to Business Planning for Companies video lecture number 1. We're going to introduce this area of business planning by looking at a number of topics, and they're listed on the screen here. The first is what I want to do is to introduce some concepts really about business planning, and that's what we have here. So we're going to talk about profitability. What do we mean by profitability? What do we mean by solvency? What do we mean by liquidity? Because I suppose business planning is looking to the future and trying to assess whether our company will be profitable in the future. What profits might they make based on certain assumptions? Will our company be solvent? Okay, we'll explain what that means. And will our company be liquid into the future? In other words, will it have enough cash to keep going into the future? So business planning is looking at these three ideas. So it's important to understand what they mean and how they're calculated and so on. They're more or less accounting concepts, particularly profitability and solvency. Liquidity or cash flows is a more commonsensical kind of idea. I think we're all familiar with cash in and cash out, and we deal with it. But the other two, profitability and solvency, are calculated using the rules of accounting. But we'll see what that is in a minute. The other thing I want to do is in this video lecture is to make a comparison, if you like, between financial management, which we're at the moment, and the subject of accounting, and what's the difference between the two of them. So it's not to confuse things. Okay, the next topic that I want to deal with in this video lecture is, of course, we're dealing with the business plan, and the business plan is made up of a number of components, 3 components, and we're going to see what they are before we can do a business plan at all. And finally then, which will take up the bulk of the lecture, I'd say, we're going to do a case study, our first business plan. Okay, so we're going to make some assumptions about the future. We can't tell the future, of course, but we can make some assumptions about the future for a business, maybe a new business that we're going to have, and we're going to do a business plan. Okay, so that's what the intention is. Okay, so the first thing I think we'll have a look at is these 3 concepts, these 3 ideas that we want to make sure that we know what we're talking about. Now, all 3 can be explained by virtue of an equation. Okay, so we're going to look at profitability first. So I just maybe do out the equation, profitability. Okay, so what is profitability? Well, maybe I won't call it profitability. Maybe I'll just so we just call it profit. So how do we calculate the profit of a business? And so the profit is easy. Okay, so the profit of a business is equal to the revenues of the business. Now, if you have done some accounting in the past, this will be this will be familiar to you. So revenues minus the expenses. So this is how we calculate it. Revenues minus expenses. Okay, so what do we mean by revenues? I might change colour here. I don't really like that colour. So the revenues then, what are revenues? Well, the revenues in a business usually are what the business sells. So the sales of the business. And these could be sales of goods or stock or whatever, or it could be sales of services that the business provides. So every time we make a sale, we send out an invoice. So I suppose how we could keep track of our revenues would be to just keep a copy of every invoice we send up, write them into a book, these invoices, and then add them up at the end of as we go along. So we'd always know how much what the sales will be. And if we're talking about the future, which we are in business planning, well, then we're going to make some estimate of what we think we're going to sell, what the sales will be. And also the sales are not the same as the cash coming in. Okay, revenues, some people think that revenues are all the cash coming into the business. Well, there are certain cash flows coming into the business that are not sales. So things like if we borrow money, that's money coming into the business, but that's not sales. Or if the shareholders give us money in return for shares, that's not sales. Okay, also sometimes sales are made on credit. Okay, sometimes they're made on credit. So in a particular year, we might have a certain level of sales, but we wouldn't have got paid for them all. So what do we include as the revenue, as the sales? Well, we include everything we invoice, whether it's paid for or not. So there are some rules, I suppose you could say, about what is a revenue, and these are accounting rules. And sometimes it's not that clear what a revenue is, but by and large, it's everything we sell during the year. Also, remember on sales, we charge VAT, but the sales figure doesn't include the VAT because we're only collecting VAT on behalf of the government, and we'll have to pay that money over to the government. So it doesn't belong to us. So it's just the net sales price before VAT is added on is what we regard as the sales. And it's whatever we sell, whether or not it's been paid for. Expenses then are the other types of figures that we're going to use in the profit calculation. And these are what we call day-to-day costs of running the business. Okay, day-to-day costs. So things like the materials, if we're producing goods, the materials that go into the goods, labour, wages that are paid to our staff, rent that might be paid, insurance, all those kind of day-to-day expenses. But not things like if you buy a machine. Okay, if you buy a machine, that's not day-to-day. That's going to last for a few years. So we wouldn't include the cost of buying a machine or any other, what we call fixed assets that are going to stay in the business for a long time. So we don't include those. Instead, what we would do, of course, if we were buying fixed assets like equipment or whatever, we would depreciate, and the depreciation would be the expense. The wear and tear in that particular year would be the expense. And what I said about VAT is the same. Like very often these expenses we'd have to pay VAT, but we only include the net amount. We don't include in our expenses there, we only include the amount before the VAT has been added on. So that's it. So this, as I said, is an accounting idea, this idea of profitability. So there's rules about revenues and there's rules about expenses. And if the revenues are greater than the expenses, it's a profit we make. And if the expenses are greater than the revenues, we of course make a loss. So this is how accountants, I suppose, measure the performance of a business, the financial performance of a business. And of course, this is very important for making a business plan, because we're going to plan the profitability. Okay, we want to know, will we make a profit in the future? Because if we don't make it, we're not going to make a profit in the future, well, you'd have to ask yourself, why would we bother? Now, having said that, very often in the first couple of years, businesses don't make a profit. So you've got to take that in mind, and that's something, when you're building up the business, sometimes the expenses are higher than the revenues. Okay, so that's our profitability. Now let's look at solvency. So again, the solvency can be expressed as an equation as well. So let's do that. This time, when we're talking about solvency, we're talking about not for a period of time, but for a point in time. Okay, and that point in time is usually the last day of our accounting period, which might be a year or 6 months or whatever it is. But of course, you can calculate the solvency at any time. But okay, so let's see, how do we do the solvency? Okay, so solvency. Well, solvency again can be expressed as an equation, and the equation would be, we're dealing with assets. Okay, assets. And let's do it this way first. So you can write an equation different ways. So we'll look at the assets, and we'll say that the assets equal the liabilities. Plus the capital. So we've got to explain these terms. Again, these are accounting terms again. So this is an accounting idea, solvency. Okay. So what are the assets? The assets are things that the business owns. Okay. So anything that the business or the company, whether it's a company or a sole trader, whatever the business owns, well, they are the assets of the business, and they have a value. And if we want to measure the solvency, we'll have to find out what's the value of all our assets. And there'll be things like fixed assets, like machines and property and motor vehicles, and also these other current assets, more short-term type assets like stock and money in the bank and money owed by customers, what we call debtors. So these are all the assets of the business. And the accounting system is designed that no matter how successful or unsuccessful the business is, the assets of the business will be equal to the liabilities first. Okay, liabilities, and these are what the business owes. Okay, so if the business owes money to people outside the business, what would that be? That would be maybe money was borrowed from a bank or something, so that would be a liability, the balance on that at that particular day. How much do we owe our suppliers for stock that we haven't that we haven't paid for yet, or maybe taxes might be owing. And here's capital then. This is another term, capital. And capital has a particular meaning in accounting. It's a type of liability. We've separated though, and because this is money that we owe to the owner, that the business owes to the owner of the business. And the owner, if it's a company, of course, would be shareholders, and if it's a sole trader, it would be just an individual. Okay, so these are the two types of liabilities. So always, as I said, assets will equal liabilities plus capital. Bear in mind that capital is also referred to as the equity of the business. So we sometimes hear the term someone is making an equity investment in a business, and that just means they're buying the shares. Okay, they're providing capital to the business in return for shares. So that's an equity investment. Okay, so we can call it capital or equity if these terms are interchangeable. Now this equation then is more often shown as follows. Well, I want to just change this equation around. So the assets of the business, okay, and we bring the liabilities over the equal sign, and we'll say assets minus liabilities equals the capital. This is what we more commonly use this equation. This is called the accounting equation sometimes, but essentially it's similar, to a balance sheet. A balance sheet includes all these figures, except the layout is slightly different. So the assets minus the liabilities then, if we subtract those from each other, we refer to that as the net assets if the assets are greater, or maybe it might be called the net liabilities if the liabilities are greater. So the net assets equals the capital. Okay, now if the assets are greater in value than the liabilities, well, the left hand side of this equation will be positive. Okay, the assets are going to be greater. And if the left hand side is positive, well then the right hand side is positive too. So we've got positive capital here if the assets are greater than the liabilities. But of course it doesn't have to be. Sometimes the liabilities will be greater than the assets, and we'll call the difference between them the net liabilities. So that's a minus figure, and the capital or the equity will be minus or negative as well. Okay, so this is kind of a measure, if you like. This solvency is a measure of sometimes it's referred to as I'll write it in here, the financial position of the business. Okay, the financial position. What kind are they, in a healthy financial position or a non-healthy one? Well, if it's a healthy financial position, we'll have net assets. Assets will be greater than liabilities, and positive equity or positive capital. And if the financial position is poor, we'll be insolvent, I suppose, and the liabilities will be greater than the assets. So we'll have net liabilities on the left-hand side, and capital or equity will be negative. Okay, so that's the financial position of the business. I'll just go up here, and just to remind ourselves that up here, this was the financial performance of the business. Just write that in. When we're calculating the profit, it's the financial performance. Okay, so these are two really important ideas, I suppose, accounting ideas, calculating the profit of a business and calculating the solvency of the business. Okay, the solvency of the business or financial position. And the third term that we need to look at and try to understand is the liquidity. Okay, liquidity of the business. Okay, liquidity. Now, when we're talking about liquidity, it's a very simple idea. There's no rules about it. There's rules in terms of the previous two calculations, but for this one there's no real rules because it's just basic common sense, and we're talking about here cash flows. Okay, so cash flows in the business. So we all understand cash flows, we all deal with cash flows every day. So what kind of equation might we have here? Okay, well, the liquidity can be measured by looking at the cash in during the period. Okay, whether that period is in the future or the past, that'll depend on whether we're doing accounting or financial management. But the cash in, we look at it, and we look at the cash out. Okay, the cash out on the business. Now, if the cash in is greater than the cash out, we have what we'd have a cash surplus. Okay, so we'd have if the cash in is greater than the cash out, we'll have cash left over at the end. So we refer to that as a surplus. But of course, sometimes the cash out will be greater than the cash in, and we refer to that as a cash deficit. Okay. And of course, households do this calculation every month. You know what I mean? If you're running a house, you'll try to work out maybe in advance what cash is coming in next month, what cash will be going out next month. So there might be salaries or something coming in, and various rents or mortgages or various other household costs would be going out. And at the end of each month or whatever, you'll be doing this. You'll have a surplus or a deficit. You'll be in the black or in the red at the end. That kind of thing. Also, governments do this. Okay, governments are cash flows and liquidity are very important for government. So cash in for a government would be usually taxes of various descriptions. You have cash in, and the cash out would be paying civil servants salaries and running hospitals and schools and all that kind of thing, the police force and all the things that governments have to spend money on. And in any period of time, then maybe the cash in from taxes would be greater than what they spend out. In that case, we'd have a government budget surplus. And other times, then we'd be spending money out more than the government is getting it in, and we'd be running a budget deficit. Okay, so we all do this, and companies do this as well. And that's what we're really interested in. Now, when accountants do this, it's a fairly basic calculation. When accountants are doing their calculations, they use these T accounts. It's shaped like a T, and what they would do simply is they'd have a T account here for the bank. Okay, and it's a very easy thing to do. Any money that's coming in, we put it in on the left hand side, or the debit side they refer to it as, and any cash going out, we put it here on the right hand side. So they'll have a running total, or at the end of any period they can just compare the in and the out, the cash in and the cash out, and they'll end up with a balance. So a very easy kind of calculation. But also, when we're doing our business plan, we're going to be very interested in calculating the liquidity of our business in the future. Now, as I said, we're not able to tell the future, but we make as best estimates, as reasonable estimates as we can about what we think is going to happen in the future, and we're going to do these calculations of profitability, solvency and liquidity for our business in the future, just like we do with accounting in the past. Okay, so that's basically all I want to say about those three terms. Okay, so let's just go back up here for a moment. Okay, so the next thing, so that's, I suppose, I just put a little, we finished with that. That's the first thing we did. Okay, the next thing I want to have a look at then, very briefly, is a comparison of what we're doing today, what we're doing in this module, which is financial management, and what we're doing anyway at the moment is financial management, and making a comparison with accounting. And both financial management and accounting are interested in these three measurements. Okay, they're interested in these three measurements, and I suppose maybe I won't go into it in great detail, but I think the most important thing to point out is that when we're dealing with financial management, okay, clearly when we're talking about management, we're talking about making decisions. That's what managers do. They make decisions, and they make decisions about the future. Okay, you can't make decisions about the past. So if you're making decisions about the future, but in the future, we call that management, okay? And if you're making financial decisions about the future, we refer to that as financial management. Also, financial management is involved in, planning, as we're going to do today, and also controlling the business in the future. We'll talk maybe later about how managers control the business. What they do is, of course, is they make a plan first, and then they compare what actually happens to the plan. And if we don't do what we plan to do, well, then we have to make some changes in the organisation. Maybe we planned wrong, incorrectly, or else maybe we're doing something that maybe we could do better, something like that. So that's financial management, future focused, okay? Future focused, about making decisions and about running the business in the future, helping to run the business in the future. Accounting is a different thing, although we're using similar concepts in both. Accounting is measuring these three things here, measuring these three concepts about the business, if you like, in the past. Okay, accounting is historical in nature, right? We're looking at the past, a recent past, maybe last year, and we're trying to work out, well, was our business profitable last year? So accounting will measure that. Was our business solvent at the end of last year? And what was the liquidity situation in the business last year? Okay, and so there's a different emphasis. So accounting is just measuring things in the past. Okay, there's a legal requirement to do this. In company law, etc., tax law, there's a requirement, legal requirement for companies to actually measure these three things. Okay, and that's what accounting is about. So accounting has to be quite accurate. Okay, it's supposed to be at least quite accurate and make an accurate measurement of these three things. Whereas financial management, because it's about the future, it's you can't be accurate about the future, so we're going to be making estimates when we're doing our financial management. And of course, there's no legal requirement to engage in financial management. If you think it's worthwhile to make plans and to things like that, well, then you'll do it. But if you don't think it's worthwhile, you won't bother. Whereas accounting, you must do it by law. Okay, so that's that. Okay. The next thing I want to do is I want to go into just another thing about accounting, just to how are these measurements done, or what documents are used to measure these three things in accounting. Well, when we're doing our accounts, our financial statements in the past, we measure the profitability of the business, and we use a document called a profit and loss account, or an income statement. Okay, and that income statement, looks at the revenues here. Okay, that we put that in this profit and loss account or income statement, and we list down the various revenues if there's more than one, and we list down the expenses in this profit and loss account, and we subtract one from the other, and we get a profit or a loss. Okay. The next one is when accountants are measuring the solvency in the past, they use this kind of equation here, this assets equals liabilities plus capital, or assets minus liabilities equals capital, and they measure the financial position, and you do that with what's called a balance sheet, or sometimes referred to as a statement of financial position. So a balance sheets measure the solvency of the business. And accountants measure liquidity, as I said, usually in a very simple way with that T account we talked about earlier. And sometimes there's other documents that describe, how the funds are used and so on. Okay, so that's accounting. Okay, so that's the second topic done, I suppose, that I just wanted to briefly compare those two subject areas, I suppose. There are two subject areas, two distinct areas, financial management and accounting. But of course, we're involved at this point in time, in financial management. That's what we're at. The next thing I want to do is this number 3. Okay, so we're going to look at the components of the business plan. So the components of the business plan, I'll list them out now in a minute. But the components of a business plan mirror the 3 concepts here that we're trying to measure about our business. Okay, so we're going to have three parts of a business plan. One will measure the profitability, one will measure the solvency, and one will measure the liquidity. So let's just list them out first before we start our case study. Okay, just go down a little So I just write this in: components of the business plan. Okay, the components of the business plan. Let's just go down a little bit more. Okay. So what are the components of the business plan? Well, we do them in a particular order. So I'll put in the components of the business plan in the order in which we're going to do the business plan. And the first thing we're going to do is something called a cash budget. So we're going to learn how to do a cash budget. And when we're doing our cash budget for, let's say, for the next 3 months, in our case study, I'm just going to do a business plan for 3 months, because it takes a long time to do a business plan. If we did one for a year, we'd be here all day. So I'm going to do a short business plan just for the next 3 months. Normally it wouldn't be that short, but we can learn everything we need to know about a business plan in a short business plan. So that's what we'll do. So the cash budget is going to tell us, is going to tell us about the future liquidity, okay, of the business, based on certain assumptions. Okay, we're going to have to make some assumptions about the future, and so we're going to see if those assumptions are valid. Okay, what kind of a state will be in from a liquidity point of view? Will we be short of cash? Will we have enough cash to run our business, and so on? Okay, so that's the first part of the business plan. And all our business plans will have these 3 components. The second part of the business plan is going to deal with the profitability. And what we're going to call this part of the business plan is a projected. Now, we only call it projected because it's projected into the future. Okay, so a projected profit and loss account. So this profit and loss account, this projected profit and loss account, is very similar to the ones that we would do in accounting, okay, for the past. Okay, looks very much the same, and the only difference is, of course, they're future estimated figures rather than actual past figures. Okay, and of course the projected profit and loss account will tell us about the profitability or lack of. Okay, and the third part of our business plan that we're going to do is another projected. And this time is going to be a projected balance sheet. So we're going to learn a lot about accounting in this, you know what I mean, as well, because these are accounting ideas, okay? But again, it's a projected balance sheet is very similar to an accounting type balance sheet about the past, except this time it's projected into the future. And this document, this part of our business plan, will tell us about the solvency of the business. Okay, so there's our three components of the business plan. So we're going to do a case study now. Might as well jump into it, and we're going to do a business plan, and we're going to do a simple one, I suppose, simple enough anyway. And we're going to assume maybe we're doing a case study, and the case study might involve us setting up a business. Let's say it's a new business, and maybe a few of us are going to get together and try and run a business together. Now, the actual type of business doesn't matter. We're just going to do a business, focus on the business plan and see how it works. So let's assume maybe that we have a product. Okay, let's say we're doing this business plan with maybe some engineering students from Kevin Street or whatever, and let's say they've developed a prototype. Okay, and let's say we're going to join them and see, can we run a business making and producing this item that they have invented, we'll say. Okay, so let's say it's something maybe that you might put in the back of a computer or something like that, and it has, does something wonderful altogether. So let's say they have a product. Okay, so maybe I'll just write down case study first of all. So it's not case study. So let's write that out. Okay, so this is our case study. This is part of the fourth item. Shapers. Okay, case study. Now I'm just going to make up figures in this case study. So in the case study, we have a product that we're going to produce, okay? And let's say from an engineering point of view, this is a feasible product, and we're very happy. It does what it's supposed to do, and we believe people will be very interested in buying this product. Okay. Now, what we're interested in doing the business plan is it financially feasible? Okay. Will this product be financially feasible? So what we have to do is, okay, if we want to figure out is it feasible, we have to do some research, some financial kind of research. That all the engineering research has been done, and it's fine. But we want to do now some business research. Okay, so we've got to gather information about this project, I suppose. Okay, so to us this is a project. It's a new business. We don't know anything about it really yet, so we've got to find out how it can be done from a business perspective. So what information would we need to collect? Okay, so you might think about this yourself. Brand new business. What kind of information would we need? Well, I suppose we want to find out, is there a market for this? Okay, so what we probably want to be doing is some market research. Now, I don't really know very much about market research, okay, but I presume it's about contacting potential customers one way or another. So let's say this product that we have is a computer-based product. Let's say our potential customers, at least initial customers, would be, say, these multiple chains of that sell computer accessories and things like that. So the market research would we'd make contact with these people, these companies, maybe make a pitch and show them what the product is like, or contact them in some way, communicate with them in some way, so that you can show off the product and see would they be interested in it. And on that basis, we get some idea of the market for this product, okay? And maybe we might get some tentative or real, orders in, that type of thing. So let's say, we talk to these people, and let's say the market size. Then we're going to get some measure of the market size, and we're only talking about 3 months. So let's just make up the figures. So let's say in the first month. When is the first month? Of course, let's have a look. Let's say we're going to start in October. Okay, let's say we're going to start in October, and let's say we anticipate, on the basis of our conversations with our potential customers, that we're going to be able to sell 1,000 units of this thing. Okay, they're very impressed with it, and they'll say, yeah, we'll take some of those. November, then, let's assume we're going to be able to sell 2,000. As I said, I'm just making these figures up. It would be done much more scientifically if you were doing this for real. And in December, we've got to try and find out, well, how many might we sell? And then we'd have to make them, obviously. We're going to sell 3,000 units in December. So at least now we know for the 3-month period of our business plan, we know how many units we've got to make, I suppose, because that's what we're going to sell. Another thing that market research might tell us is how much will our customers be prepared to pay for the product. Okay, so we might have a price in mind that we would want to sell the product for, but that might be unrealistic. But following our conversations with our potential customers, we'll be able to figure out what price we can get away with, I suppose, and we'll cover our costs and things like that. But let's say we don't know if it'll cover our costs, but let's say the best price we hope to get for this thing would be €20, whatever it does. I don't know what it does. Okay, so that's our market share. So that's okay, useful information, from the market research. Well, what else do we need to? What other kind of information would we need to collect in respect of our new project? Well, I suppose we'd want to find out, well, what will the estimated costs be? What will our estimated costs? We're going to make this thing, so we're going to have costs of production, I suppose. So what will these production costs be? Well, I suppose because we have a prototype of this thing, we've made one already, or someone has made one, we know how much it costs to make. So the estimated cost might be materials. Okay, I don't know what would go into it. Materials, I don't know, metal, copper parts, or God knows, some accessories of various descriptions. So, but let's say the material costs is at €4 per unit. So every unit we make, we call them units, every one we make of these things, it's going to cost, we're going to have to put in €4 of materials into it. Okay, now let's say we're going to work in the business. The people who are going to set it up, maybe we're going to form a limited company and we'll take a shareholding in it or something like that, but we're also going to work in it. So we're going to provide our labour cost, and I suppose we don't want to take too much out of the business. We want just enough to live on. Okay, so let's say that the labour costs are 8,000 a month, we'll say. Okay, 8,000 a month. Whoop. Per month. Okay, so that's the labour cost. So we've material costs of €4 per unit, and the labour cost for us all collectively 8,000, maybe, you know, whatever that is per person, 1,500 a month or something like that. Okay, and the other costs then, the other costs of production, I suppose, are sometimes referred to as overheads. Okay, and these would be things like rent and insurance and telephone bills and light and heat and all those other things. Now, while the materials are easy enough to work out, you know, we have a prototype, so we know exactly how much it costs in materials to make the product, and we know how much we're taking out of the business ourselves because we've decided how much we want to take. The overheads are more difficult. Okay, so we would have to do some fairly detailed research, talking to various people maybe in business or talking to estate agents about the rent, and so it's more difficult to actually calculate in advance what your overheads are going to be. So while it's difficult, it's not impossible. So let's say we have done that, and we've decided that in October our overheads, all the various other costs that we're going to have in our business, that in October they will amount to 9,000. Okay, in November they will amount to 11,000, and in December they will amount to another 11,000. So these are all our best estimates of what the costs will be in the future. Okay, if everything goes according to plan. Okay, the next thing I suppose we'll have to talk about is, well, how much money do we have? We're going to need some cash. So to set up a business, it takes money to set up a business, and there's a number of ways to get money, to start up a business. One is to go to a bank, okay, and I suppose if we go along to a bank, the first question that the bank manager will ask us about our project is, well, how much do we need? And we don't really know how much we need. Okay, that's the big problem with this. But hopefully when our business plan is done, we'll know how much we're short of, and we'll be able to tell the bank manager or whoever it is how much we need to borrow. But I suppose we're going to have to put some money in ourselves. So, so we're going to invest a certain amount of money. So let's say there's 5 of us. So let's say we all put in 4,000 each. So capital available. Capital that we're going, remember the money that the owner puts in, or we refer to that as capital or equity. We're going to put some of this equity into the business, and let's say collectively we're going to put in 20,000. Okay, 20,000. We're going to borrow it maybe from a relative or something like that, don't know, or savings or something like that. The next thing then, the next bit of information that we've got to collect is, well, if we're going to make something, going to make these items, I suppose we're going to need machines or equipment or something like that. And let's say we found some second-hand equipment or something, and there's another company maybe either closing down or retooling or whatever, and they have this equipment available, and let's say the equipment, we can get it for 15,000. Okay. Any other bit of information? Well, I suppose another bit of information is, and I suppose this will come as a result of our market research. These potential customers that we have, they're in business a long time, so they'll probably be wanting credit. Okay, so when we sell to them, they don't want to pay immediately, so they'll expect a certain amount of credit. So let's say we have to give them 1 month's credit. So I'll just put that in there, 1 month. And this is very important. It doesn't sound important when you're starting off. 1 month credit to customers. And we'll see that this is extremely important. And it may decide whether we go ahead with this project or not. And the final bit of information is, because we're a new business ourselves, okay, that no one knows us, so or no one trusts us maybe, or whatever, but we no credit. We cannot get credit from our suppliers. No credit from suppliers. So let's say they're the assumptions, okay, that we're going to go forward with these assumptions, and we believe this is the most realistic thing that's going to happen. Okay, this is what we believe will happen. So with that information, we don't really know very much. Okay, we're still very unclear as to how much money do we need to borrow? Will we be profitable? Will we be solvent at the end of a period of time in the future? Is this a good idea to go into business? So to help us answer those kind of questions, we're going to produce a business plan using this information, using the information we have here. So we said that there's 3 components to the business plan. Okay, there's 3 components, and what did we say they were? We said there was a cash budget, which is going to tell us, will we have enough money? Okay, will we have enough cash? Do we need to borrow? How much do we need to borrow? So we'll do that first. We're going to do our first cash budget, and then we'll go and we'll do will we, based on our assumptions about the future, will we make a profit? And based on our assumptions about the future, at the end of the 3 months, remember we're only going to do it for 3 months, will we be solvent, okay, or will we be insolvent? Now, if we're going to be insolvent, that's not a good idea. So we want to be sure that if we go into this, that we don't lose everything, lose the money, and waste our time on this project. Okay, so let's do the cash budget first. Okay, now where am I going to do this? Let's move over here a bit, and we'll go up a little. Oops, too far. Okay, so I'm going to do the cash budget here then, and just see how it goes. Okay. So let's give it a title. I suppose we'll say what it is. So we always have to, we're going to be writing numbers here. Better say what it is. So it's a cash budget. Why is it not working? Oh yeah. So cash budget. So that's the document we're producing. The first part of our business plan, budget. That's not right. Cash budget. And we'll always put in the period that it relates to. Okay. Okay, and it's for the 3 months. Ended. And it's ended at the end of December, I suppose, this year, 31st of December 2000. And I suppose we've got to make a name. I'm not very imaginative, so we'll just call the name of our business. Let's say we're going to form a company for this, and we're going to call our company XYZ Limited. Best I can do. Okay, XYZ. We put a line underneath that. That's our heading. So now we know, anyone reading this, they know who it is, whose cash budget it is, and what period of time we're talking about. Okay, and so on. Okay, so with a cash budget, we're going to do it on a monthly basis. Okay, so we're going to do a column, it's like a table here we're going to do. So we're going to do October, November, December. There are 3 months. So we're going to look at the cash flows. Remember, we're talking about liquidity here. So we're talking about cash flows in and cash flows out. And we're going to have a column then for the total for the 3 months. Okay, so there's our 3 months. and the total 3 months together. And everything's in money. So we put in a currency symbol. Okay, so this cash budget itself then is also in 3 parts. So the first part of our cash budget is very simple. It's a very simple document. As I said, many people do this. Cash in. So what cash are we going to get in? What sources of cash do we have? Well, if you look back at the limited amount of information we collected about our business, there's only really 2 sources of cash. And one is from the customer. When we sell the customer our goods, they'll pay, but a month late. But also we're going to put money into this business, into this company. We're going to invest. The 5 of us, whoever we are going to invest our money in the business. So, and we said we're going to put in 2,000. So I suppose the first thing we're going to say is cash in. We call it capital or equity. And this is money from us. Now we're going to remember in business, whether it's a company or not a company, we always treat the business as being separate from us, the owners. So if we're putting money in the business, it's cash in as far as the business is concerned. So when will we do this? When will we put the money in? Well, the business is going to need it up front. So we're going to put this in on the 1st of October. And that's all we're putting in. So we won't put in any more capital after that. So that's a total of 20,000 then for the 3 months. Okay, so that goes in October, the first month. And then we're going to sell goods. And we're going to sell these goods. Now, how much are we going to sell the goods for? We're going to sell the goods for 20 euros. Okay, and in the first month we're going to sell 1,000 units. Second month 2,000 units. Third month 3,000 units. So our sales in October will be 1,000 units multiplied by 4 euros the price. No, multiplied by 20 euros the price. So that's 20. Our sales in October will be 20,000. But because we're selling anything we sell in October, we're giving 1 month's credit, so we won't expect to get paid till November. So we won't receive any money from our customers in October. Okay, and anything we sell in October, the 1,000 units, we get paid in November. So we're going to receive 20,000 in November from our customers. And how do we calculate that? Well, it's 1,000 units. Okay, and 1,000 units multiplied by 4 euros. No, sorry, multiplied by 20 euros is the price. So that's how we get to 20,000. Okay, it's the sales of October. And what will the sales in November be? Okay, the sales in November, well, we're going to sell 2,000 items for 20 euros each. That's 20,000. But of course, when we sell them in November, the customers will expect a credit. And so they won't pay us, if we're lucky, they won't pay us till December. So they're going to pay us 40,000 in December. How do we get that? Well, that's the 2,000 items, 2,000 units we're going to sell, and multiplied by 20 euro. So that's how we get to 40. Now what about December sales then? In December we said we're going to sell 3,000 items, okay, and at 20 euros a go, that's 60,000. So that will be the sales of December, all right, that's what we're going to sell, but the cash won't come in until January of next year, okay, and we're not doing a cash budget for next year. We're only doing a cash budget for these 3 months. So the only cash coming in these 3 months is the 20 coming in from customers in November and the 40 in December. And at the end of December, we will be owed money by our customers. Our customers will owe us for the 3,000 we're going to sell in December. And that, of course, will be 60,000. But that 60,000 is a debt owed to us at the end. The cash will not have been received, so we call that debt debtors. And it'll be one of our assets that we're going to put in our balance sheet, our projected balance sheet when we come to it. So that's that, okay? So we can add up then all the cash we're going to get from our customers. 20 plus 40 is 60. Okay, so that's that. There's no other cash coming into this business. There's our cash in. So we know now, which is useful information when you think about it, that we know now in advance that we're due to get in 20,000 in October. That's from ourselves. Okay, the company will get another 20,000 from the customers in the next month in November, and we'll get 40,000 the following month in December. And that's a total of 40, and what is it? It's 80,000. Now that is kind of useful. Okay, if you're running a business, it's good to know in advance, okay, how much money you expect to get into your business. Okay, that's the first part of the business plan. The second part, as you probably guess, we just simply call cash out. So a very simple document, cash out. So if we look again at the information that we presented a little bit earlier as to what cash flows are going to go out, well, there's a few things that we're going to spend money on. The first one is what we might call purchases. Purchases has a particular meaning in accounting and finance. Purchases means buying buying something that you will sell on, or materials that you will incorporate into a product and then sell on. Okay, so we're the raw materials we're talking about here, the purchases of raw materials. And so how much will that be? Well, we're going to have to make 1,000 of these things in the first month. Okay, and the material cost is €4 each, so that should be 4,000. So how do we get that? I just put that. If you were doing this in an exam or for real, you wouldn't bother with what's in the brackets here. So I'm just going to put in there 1,000 units multiplied by €4 this time. The material cost going into each item. Now we're assuming we're not building up stock. We're only making what we need to sell in that particular month. A bit unrealistic maybe, but okay. The next month then is, so that's I have 1,000 by 4 and I have 40,000 in there. That's not good. So I have to knock off a 0. Okay, so that's that done. And in the next month then we're going to have to pay out for materials 8,000. Why is that? Well, because we're going to sell and make 2,000 items, and it's going to cost us in terms of material €4. Okay. The last month then we're going to need to make 3,000 items, and each one cost, and the materials of each cost us €4. So 3 4s are 12, so it looks like it's 12,000. And again, I put in brackets how we calculated that. It's 3,000 multiplied by €4. Okay, now we get the amount for purchases for the 3 months together, and what does that add up to? 24,000. So that's it. That's our purchase cost. That's one of our main costs, I suppose, in the business. Labour costs are next. This is the money we're going to pay ourselves, and we agreed this in advance, so we know for sure that's what we're going to get out of the business for working every hour. You know, in the business you have to work a lot, I suppose, to get it started, and that's 24,000 as well, coincidentally. The next cost then is the overhead cost. These are the costs of other costs like rent, insurance, telephone bills, anything you can think of, marketing maybe, all sorts of costs that we might have to incur, and we work that out, and we know, well, we don't know, but we expect that this is what it's going to cost. 11,000 and 11,000, and that adds up to 31,000. And anything else that we have to pay money out for, and there's the equipment. So we're going to buy the second-hand equipment, so we're going to need to spend money on that, and we need it up front. I suppose we need it, you know, at the beginning of our project, 15,000. And we're not buying any more equipment after that, so it's just 15,000. Okay, let's add up these columns. There's no other cash flows out that I can see in the first 3 months of our business, based on our assumptions. So we'll add up these 4 columns of figures, I suppose. If we were doing this for 12 months now, we'd have 13 columns, okay, because we'd have, and normally it is for 12 months we'd be doing it. So you'd have a column for each month, 12 months, and a total column. So let's add this up. So we add up the first column, comes to 36. Next column, 27. The column for December, 31. And the total column then 94,000. So again, useful information. We know what we've got to spend the money on, you know what I mean, each month. So, you know, it's useful in itself, you know, for running the business, from a managerial point of view. But of course, this business plan, where it's going to go, of course, is we'll probably use this business plan to bring to the bank when we're looking for money, or we might be looking for other investors, and they'd expect to see a business plan like this. Right, the third part of this cash budget then is as follows. There's 3 rows of figures going across. So I'll just write them in first. The first one is opening balance. Okay, I'll just write them first before I explain it. Next one is surplus. We said already what surplus was, when there's more cash coming in than going out. And then we can also have a deficit. And we normally show the word deficit in brackets because to indicate a minus figure. So instead of putting a minus sign before a figure, we put the figure in brackets. And the last line, or the last row of figures going across, is closing balance. Now, what do we mean by these 3 terms? Opening balance. Okay, opening in finance and accounting, it relates to the beginning of the period, whether it's the beginning of a month or beginning of a year. We talk about the opening balance, okay? And the balance of what? What are we measuring here in this document? Well, we're measuring cash. So we've got to say, okay, well, how much cash did we have in our business at the beginning of the month? Okay. Surplus or deficit, I think we know for each month, is there more coming in than going out? That's a surplus. Or is there more going out than coming in? That's a deficit. And the closing balance, closing in accounting and finance means at the end of the period, month or whatever it is, year, and balance again, balance of cash. Okay, this is a new business. Okay, so there was nothing in the business at the beginning, so the opening balance of cash is 0. Now, I know you might say, well, what about the 20,000 we're putting in? Well, okay, well, we included that in the cash in during the first month. Now, we have a choice. We could either not include it where we did include it in the cash in and instead include it here if we wanted it, but we can't do both. Okay, so that's basically that. So the opening balance is 0. Now, what is the surplus or deficit? Well, you can see there that the cash coming in is 20. Okay, we expect it to come in 20, and the cash going out is going to be 36. So that's not good. Okay, so there's more going out than coming in. That's what we expect based on our assumptions. So we have a deficit, and the deficit, of course, is 16,000, and that's just 36 minus 20. So we're short 16,000. So we really do need to borrow money then. Okay. We need to borrow at least 16,000, maybe more. When we'll see what happens in the following months. So the closing balance, okay, if we just leave it as it is, we're going to have an overdraft of 16,000 in our bank, if we're allowed. Okay, so we might have to go and get an overdraft facility, which is permission from the bank that our account can go into negative figures. 16,000. Okay, so that's our first month done. So not looking great. Okay, so what about the opening balance then in the following month, which is November? Well, the opening balance, if the closing balance in October is 16, that's at the close of business on the last day of October. Well, okay, the next month then, or the next day comes around, the next morning comes around, nothing has changed. So on the 1st of November, you're still going to have this be in the red, if you like, 16,000. So whatever's down here in one month, the closing balance of 1 month always becomes the opening balance in the next. Okay, so we're starting off November with a negative figure of 16 in our bank account. What happens in November then? Have we a surplus or deficit? Well, cash in 20,000, cash out 27, so another deficit. Okay, so things are going from bad to worse. So we have a 7,000 deficit in brackets again because it's negative, and at the end of that month we're going to be 23,000 overdrawn. So how much do we need to borrow? Well, 23 it looks like. Okay, at least 23. We'll see now, do things get better or worse. So what about December then? The 1st of December, the opening balance 23. Oops, I forgot to put brackets in here. It's a negative 23. So 23,000, we're going to start off December with a minus figure in our bank, minus 23. Again, the closing balance of November becomes the opening balance of December. Now, have we a surplus or deficit in this month? Well, we've 40,000 coming in, 31 going out, so that's a surplus, thankfully. So we've got 9,000 positive. Okay, 9,000 positive. So a surplus for the first time. So what's our balance in our bank going to be if everything goes according to plan? 14,000 negative. Okay, so that's that. So I suppose what this is going to tell us is, okay, the business, we don't know anything about the profitability yet, we don't know anything about the solvency, but it has a liquidity problem. Okay, it has a cash flow problem. And we can solve one way, there's a number of ways to solve a cash flow problem, but one way is just simply to go out and get an overdraft of 23,000. And that should help us. Let's do the final column. Okay, let's do the final column here. Again, the opening balance, this for the 3 months together. Well, the opening balance at the beginning of the 3 months is going to be the same as the opening balance at the beginning of October. So that's 0. Okay, and then for the 3 months together, the cash in is 80, the cash out 94, so we've got a minus 14. So minus 14 plus 0 is minus 14. And we knew that had to be the case, okay, because it's at the end of December. So these two figures have to be equal to each other, okay. They have to be equal to each other because we're talking about that the same day. So we anticipate that at the end of our 3 months, we will have an overdraft of 14,000. So we need to go to our bank and explain the situation and ask for this overdraft. Now let's say we do that and we go to the bank and they say no. Okay, let's say they say no, we can't give you an overdraft, sorry about that. So how are we going to, is there anything else we could do? Okay, if they don't give us an overdraft? Well, there are a few things, a few possible solutions to this liquidity problem. What's causing the liquidity problem? Well, I suppose what's causing the liquidity problem, one thing that's causing the liquidity problem is the fact that we're giving credit to our customers. Okay, so we're giving credit to our customers, which is delaying the money coming in. And our customers at the end of December owe us 60. So if there was some way we could reduce the credit terms to our customers, that would solve our liquidity problem. And, you know, ideally they would pay us cash. In other words, there'd be no credit. And if there was no credit given to customers, well, that 20 there in November would come in October. The 40 in December would come in November. So everything would move to the left on this row. And the 60 that we're not even including, and that's going to come in January, the December sales would come in December. And in that way, we'd have an extra 60,000 in this 3 month period. So, you know, that might be possible if we talk to our customers and say, listen, we're a new business. Would it be possible that you pay us up front? Or, you know, if they're not agreeable to that, maybe 2 weeks credit. And if it was 2 weeks credit, half of this 20 would come to the left, half of this 40 would move to the left, and half of the 60 in January would move to the left. And that would solve our problem as well, because that would be an extra 20,000 and that would solve our overdraft of 14. Okay, sort of. Okay, it mightn't completely solve it because we actually go to 23. Anyway, okay, what else could we do? Well, we could to improve our liquidity situation, our cash flow. We noticed that the purchases, we're not getting any credit from our purchases. Maybe we haven't looked hard enough, okay? And maybe it might be possible that some or all of these purchases we might get credit if we look harder. So if we did get credit from our suppliers, well, that 4,000 there, let's say we got a month's credit, well, we wouldn't pay that 4,000 in October, we'd pay it in November, the 8 we'd pay in December, and the 12 we'd pay in January. So it would move everything to the right, and that's delaying money going out, and that would help our liquidity. A big problem that's been a big source of the problems of our liquidity problem is this here, the equipment. We've had to pay out 15,000 upfront for our equipment, and that's a lot of money up front when we don't really have it. And I suppose there are alternatives to buying equipment, and that is leasing or hire purchase. So instead of paying out 15, we might spread the payments out over 3 years and maybe pay 300 a month or something like that. So it'll be 300 here, here and here, and that's 900 in the 3 months. So that would be very useful. That would solve our liquidity problem. Okay, so there's a number of solutions to liquidity. Okay, maybe I'll just write those what they are. I'll just write them down if I can do that. Let's get down a little bit. Okay, so solutions to liquidity problem. Okay, I'll just put to solve a liquidity problem, or a cash flow problem. Is the same thing. There's a number of things we can do. First one is reduce credit to customers. Number 2, increase credit from suppliers. Okay, number 3, lease the equipment. Don't buy the equipment because that's a big lump sum. Lease the equipment instead and spread it out over a few years. Number 4, another solution to a liquidity problem is borrow. And another one is, in other words, we just go to the bank, ask for an overdraft facility, that'll solve it for us. Liquidity is an easy problem to solve. The other two, profitability and solvency, are more difficult, okay, particularly solvency. And the final thing we could do is we could try and find some new investors, okay? And I'll just refer to that as a new equity, because that's when the owners put money in. We could find new people to put money in, or we could put more money in. So a new equity investment in the business, that would be more cash coming in. Okay, so we've done a fair bit here. That's the first part of our business plan. Okay, and so what did we do? Let's just go back and just see what have we done. So, oops, sorry. We go over here. Okay, I'll just go up here now and just recap a little bit. Okay, so this is our first video lecture, business planning for companies, and we looked at a number of topics. Now we're not finished, of course. Okay, so we looked at a number of topics. So we explained what profitability, solvency, and liquidity was. We did a short comparison between what financial management and accounting. We looked at the 3 components of the business plan: the cash budget, projected profit and loss account, and projected balance sheet. And we introduced this case study of a business plan, and we did the cash budget. So we've yet to do the next 2 parts, and that's the solvency and the liquidity. And I'm going to do those 2 parts in the next video, in video lecture number 2. So talk to you then. All the best.